All right, I got a request from Ben Hoskins to do Facebook. So here we go, the FB Facebook. And Facebook has this really, really good long-term bull market line that does pretty much the whole stock on one line. And so this is a critical spot. We've got some balance sheets and we've got the current action we'll get in here. This is Brian Lewis with MMT Investing, and things just changed. So if you like the technical analysis things, the gaps here, Facebook has done a good job filling all the gaps that it gets. And so this is technically a pretty good stock as far as behaving in ways that make sense and following trend lines and things like that. And we are getting very close to a critical trend line here. And I guess I could get the volume up here and check it out. But the volume has been decreasing in most of the, oh, not that one. In most of the charts. And I would expect, nope, it's not decreasing. Well, I mean, a little bit, but it's not down to like oh yeah, it is kind of down to a regular level. It didn't get as crazy volatile as most the rest of the S&P. Oh, okay, so this gap was high vol, and yeah, okay, the volume's not like running out of gas for Facebook as much as the general S&P. So I guess let's talk about the balance sheet, and then I'll do some MACDs and zoom in a little bit and see what this thing looks like. So they have their quarterly reports in. This quarter they have more cash than last quarter, a little bit less debt. Their their cash was like 23 and their total liabilities was like 15 or something. I can't remember. I just looked at it. Anyways, their cash is ahead of their current liabilities, which is good. It's not like an incredible balance sheet like PayPal or something like that with no debt, but they're ahead cash to currents, and then their total liabilities are way ahead of their assets. It's like 4 or 5 times. So their balance sheet is fine. Their business model is great. It's a internet-based business that can fully operate in the lockdown conditions. And you see things like Shopify coming up, and Facebook ads are huge for the new kind of business models for advertising new online sales. So Facebook is a good business model. I mean, they have their legal issues from time to time and their their government issues and that sort of thing. So there's definitely risk in this stock, but it has been a very solid, pretty stable bull market line. And this spot is critical here. Let's talk about the cycle, I guess. Where are we? 20 here. Okay, so the S&P did this kind of rip down and did this kind of move over to here. Not as big of a bounce as Facebook. It's kind of level with the dead cat. So Facebook is getting a rip up and getting close to their own kind of trend line. And if we get a turnover here in the general S&P and the credit cycle here, right while Facebook's approaching their trend line, I would expect them to bounce off of this thing. And this is not investment advice, but this looks like a good spot to kind of book profits on Facebook and just see what happens, because this trend line is really important. And we'll do the MACD in a second, but I mean, Facebook wants to get above this thing before they can get any more positive movement. And if they get the entire world monetary credit cycle pulling down on them right as they're approaching this trend line, that could be a bad thing for them. So this is kind of a critical area, and it's high risk area. So I guess just tread carefully is the general idea here. But let's take a look at the MACD, how they've been doing. because they've had some bearish side activity when most of the S&P was bullish. What are the dates on this? September. Okay. December 18. Oh, okay, so this is the Volmageddon crash here, and then okay, so Facebook has not been as bullish as the general S&P, or definitely not as bullish as the Nasdaq on this bull market run up to the everything bubble crash here. They haven't been in bull territory quite as much as everything else, but they are sticking on this bull market line. And there's not really another line to work with as far as resistance or anything else. That's pretty much the line. And they've been really responsive to credit contractions. I mean, they pull down. They pull down when it pulls down. So I think a credit contraction here is pretty scary for the Facebook stock, especially as they're approaching the resistance here. And then let's get in on the current MACD, see what's going on. So I mean, they're way up in bullish territory here on the MACD. And it doesn't look to be turning over right now. It looks like it's just still headed up. And so for this to become bearish, it needs to turn over and it needs to get back down on the bear side. So any kind of wobbles that you get up here on the bull side of the MACD are going to be bullish. And if it swings down to the bear side down here, then any wobbles that you would get down here are going to be bearish. And so that's the general look at the MACD. For Facebook, it just looks bullish right now. And there's no indication that it's going bearish right now. But this is a critical line where we probably will see some action here that's a little more telling over the next week or two. And their quarterlies are good, and the general economy and the credit contraction is not good for sure. But their business model long term looks good. So let me jump out onto like the weekly and check out the long term MACD. Okay, here's the longer term, and you can see on this one that they have been long-term bullish, very bullish for the whole time, except for this credit contraction, the Volmageddon period and the 2018 crash. They went really bearish, and right now they are long-term bearish. They're down here, and so that's not a good look for maybe a 2-year kind of outlook. And so what the bulls would be looking for, it's turning up now. So if this does swing from here up into bull territory, then that would be very bullish. And if it reverses down on the bear side of the line, that would be very bearish long term. So right now it's bearish and it's starting to turn up and it's crossing over. So it should be headed up right now. But it's still bearish, and it's really important where the next turnover is. Does it turn over in bear territory or around even or a little bit up, or does it actually get bullish and get back up here somewhere? So that's the long-term MACD. Let me get on the closer action and see what it looks like right now and maybe do some short-term technical analysis. Okay, so I'm on the hourly candles now. We'll take a look at some shorter-term technicals. We have some gaps here. Gaps. Gap. And so we got back to this level here, and we have not gotten back to this one. So this is an area to look out for. And it looks like we got a big reaction off of this line already, which is pretty interesting. It shot up there and tagged it. And let's see, this trend line might be better if you pull it down onto this gap here. So that the gap sheets down. Is that a weekend? That's a weekend. I'd completely ignore what I just said. That's not a real gap. That's just downward movement during the credit contraction. So it looks like we hit this trend line and reversed off, and we got a little kind of a little bullish pennant kind of thing, and got some more up. And we're just getting close to this area here. That's the same thing that I said on the longer term, and nothing particularly crazy or interesting. Just volume is decreasing a bit, and so I don't know. I don't know what's going to happen if we see a reverse out of this area and sort of the credit contraction turnover in the general market. Then I would look for kind of this area as a downward target for this gap. And if we don't get that kind of turnover in the general market, then we'll have to see if Facebook bounces off of this thing or gets above it. And so this is a really important area. And the short term MACD here is looking pretty bullish. It's starting to turn down. So that should open up potentially. And so yeah, any kind of more wobbles that we get here on this side is going to be all bullish. And if it crosses over into bear territory, then that is will be a turnover. So that's just going to look on Facebook. It is sort of, I forgot what it was. It was like medium term bullish, long term bearish, short term bullish. So this is a really difficult one to get a good read on. It's just getting close to a critical zone here and just needs to be watched carefully. And I don't have any Facebook, but if I did, I would be booking it right now. I'd be selling this thing and getting profits and just waiting to see what kind of action we get before proceeding with Facebook. And that is the outlook. So please hit the like button to help me out with the YouTube algorithm. And I have a new little subscribe button, hopefully over here somewhere. And yeah, I don't have a whole lot more on Facebook, I guess. Just that the online advertisement kind of thing is a good business model. And I was looking at Shopify, which is highly related to Facebook ads. Shopify people dump tons of money into Facebook ads, and Shopify is going nuts. So that is good for Facebook. And then yeah, just kind of similar models. I mean, like the Google ads and stuff like that. Those are all really good business models with high income and low debt. Although, of course, companies closing down is not going to be good for advertising in the short term. But as far as long term outlook, that business model looks pretty solid. I mean, if brick and mortar stores start closing down, that's not going to affect the Facebook ads so much as the online retail stuff that should be picking up in its place. So I like Facebook, and I don't particularly like where they are right now. And then, of course, the cyclical model is looking to turn over. So we have like a 3 to 4 month credit contraction cycle right now in the world monetary system. And this is the beginning of the contraction. And then you get sort of a middle kind of bounce that usually kind of turns over, and then you get like another bounce or something like that. That's kind of the general shape that you get in a credit contraction cycle. And now we have kind of overrun really long, and the time estimate is getting more difficult here. I don't know. I don't know if I should be trying to expect. Oh no, I got a wobbly thing again. I don't know if I should be trying to expect another bounce or just a turnover, or I don't know. I'm trying to track the cycle, but we should definitely get some more down movement before the end of this credit cycle, and then we should be looking for a consolidation zone to kind of switch into an expansion cycle. And we've seen the Fed and Congress getting ready for another contraction. So, like Jerome Powell was just talking about 2 days ago that the Fed is now prepared to buy junk bonds, which they announced that they were going to start buying corporate bonds during this down cycle, and they did start to do that. But as soon as they announced they were going to buy corporate bonds, then the bond market started going up on its own without them buying the corporate bonds. So they didn't really have to buy that many. And then we saw companies like Boeing getting private financing. They didn't even need a bailout because there was liquidity. And so the Fed announcing now that they're not only looking to buy more investment grade corporate bonds, but they're looking to buy the junk grade corporate bonds. And it's specifically the angel bonds, which is like the ones that moved from investment grade down to junk grade. So they used to be investment grade. Like they're looking at those tier of bonds as something that they can buy right now. And they're not talking about trying to buy stocks outright yet, which is good because they're not supposed to be doing that. But that's the Fed's plan kind of for bailouts right now, is instead of actually giving bailout loans with all the stipulations and all the bad press, they can provide liquidity through buying bonds. And so they're just extending the amount of bonds that they're prepared to buy now because they don't respond that fast. They need to get prepared so that they can react faster when it happens. And just the fact that they're doing that, and then we saw the Bank of England reporting that all the banks across Europe are blowing their emergency funds like 6 times, 10 times in Italy, or 12 times. And that's the fund that the banks keep on hand in order to handle defaults when people stop paying their loans, are going up like, they're going up like sixfold in America, and they're going up tenfold in parts of Europe. And those are all signs of the credit contraction. And also you see houses like the housing loans are already getting tighter too. Like they're changing the credit scores available that you need to get housing loans, and they've completely canceled the jumbo loans, which are like the expensive houses, which is affecting the LA market a lot. And you see that in all the sectors. And now the credit cards are changing their rules, and you need a better credit scores to get credit, and they're giving smaller credit limits. And so you just see that kind of credit contraction tightness all over the world in all the different credit markets. And that credit contraction is what does this move down. And this was the initial contraction when it hit the market. And then you usually get a little bit more contraction at the end of the cycle. So that's what we're looking for now, is just a general kind of turnover in the credit contraction cycle until we can get to a spot where we get an expansion and we get more money available to loans and businesses and things. And then I guess just talking about the health situation and the lockdown, like basically during this entire wave down, everything was open. And then during this wave up is when everything was locked down. And now that they're going to open everything back up starting next week, probably will be when it starts coming down again, just because it's ridiculous and it makes no sense. But that's not what drives the stock market. The stock market is pro-cyclical against the monetary system, and it has to do with how much money is available. And it's a worldwide system. And when the contraction comes on, it just pulls things down. And that's just kind of the secular movement that you get in the stock market. It has to do with the monetary expansion and contraction. And that's why you generally get tons of bull market kind of activity, on this side of the MACD, is because generally you're in expansions in the monetary system and businesses can get the money they need to operate. And then when you get into a contraction, the debt becomes a huge problem. And then everyone starts hoarding their dollars all across the world and trying to pay their debt and just getting defensive to keep their business running. And that's what you see in the market, is that reaction to the credit contraction. So we're looking for a contraction to continue here. And where is this, June or something? So on the timeline, I'm looking early June to kind of be the area where it probably is where it'll probably switch into a positive. And so I don't know I guess on Facebook, this gap right here is kind of a good area to look at for a down target, and it might kind of bounce down there, or it might rip down there and get back up or down. I don't know. Just like to get down here at some point if the credit contraction comes on is a good target for Facebook. And if we just keep going up, then you want to see Facebook get above this line and just get out of there, or not get below it again. So that's Facebook general area. Good balance sheet, good business model. Kind of mixed fundamentals here. Not really clear signals. Just a risky area, and I think I said all the things. Like button and stuff. Subscribe. Not investment advice, and happy trading.